Hey guys, welcome here to another video. Now, as we've discussed, that stock market is a place where investors connect to buy traded listed company in the stock exchange. How you make money in the stock exchange, ladies and gents, is that from the company that you just recently bought, as the share price of that company goes up from the price that you bought that company, ladies and gents, is the more you make money, or you start making money from that, which is something that is pretty exciting. Meaning that, for example, if you buy a company that is trading at 10 rands per share, and that company goes probably in the next 6 months to 15 rands, it means that on that company, whatever you have put, or the money that you have put, has grown by 50%, because from 10 to 15 rands, ladies and gents, that is a 50% increase or 50% jump, which is something that is pretty exciting. So the good thing about the stock market is that, ladies and gents, you can make 50%, 20%, 10%, 100%, or even 1000% if you are able to pick up a company that is set to do very well very early. So this is something that is pretty exciting about the stock market, is that if you are patient enough and you find the company that is set to do very well, most of the time you will be able to make money. One of the mistakes that people do in the stock market is that they buy companies because they are seeing other people doing that, or they heard someone saying that buy that company, without doing a proper due diligence, which ends up making them to lose their money. So make sure that, ladies and gents, you do your own due diligence, and also subscribe to this channel, or on this channel, because on this channel, ladies and gents, if a couple of you are suggesting that I do an analysis on a certain company, I will break it down for you and tell you, according to my personal opinion, if that company is worth your penny or not. You will know that how you find good companies is by analyzing their financials and checking, of course, and comparing their financial against the industry, which is something that, of course, will make you make a precise decision on choosing which company to buy. And as to how you start doing that, ladies and gents, from their latest earnings, latest financials, you check their revenue growth. Is their revenue growing? If their revenue has been growing from the previous period, then it is a good sign that that company is a good company. Whereas if it has been on a decline, then it's not a good time probably to buy or to consider buying that company. But you just have to also check if the decline of that company's revenues is affecting or is having an impact on the entire industry that that company belongs in, or is it just an issue with that specific company. Then if it's just an issue with a specific company, then, ladies and gents, it is not a good company to buy. Now, the very second thing that you look at, which is also important, is the earnings per share, the EPS. If it's a profitable company, you must check how is the EPS positively increasing, which if it is doing that, then it is probably a good company to buy. Whereas if it is decreasing, meaning it is becoming less profitable than the previous period they reported their earnings, then it's a red flag. It's something that you have to investigate further and determine what's causing that company to report such an earnings per share. Now, the third thing that you would want to check in a company is their cash balance, or cash and cash equivalent. Now, cash and cash equivalent is basically the amount of money that a company would have at hand, because this is very important, because cash and cash equivalent, or cash at hand, it provides the highest level of liquidity, which is something that is pretty exciting. And investors or big institutions preferably like companies with a huge cash and cash equivalent, or a huge amount of cash at hand. So this is also something that is very important. Now, the fourth thing is current ratio. Current ratio, ladies and gents, is the ratio that, of course, it tells you how the assets are compared to the liabilities. So if this value is over 1, it means that the company, ladies and gents, it has got more assets than the liabilities, which is always good. So it is always good to buy companies with a current ratio, which is assets divided by liabilities, of over 1, because then that means that that company has got more assets than liabilities, which is something that is pretty exciting. So with that, though, these 4 key terms are some of the main key terms that you would want to go and look into before you choose a company to buy. I know there are other key terms that you can use to analyze a company, but To me, these are the most basic, of course, key terms that you would use to analyze if a company is worth your money or not. And you must take note that there are companies that have got a serious potential in the future and are not yet profitable now. Those companies, again, you sort of like use the same metric to evaluate them, except for their EPS. Because they are not profitable, they will have a negative EPS. And how you check that is how close are those companies getting to report a profitable EPS. If they are becoming better each and every time they report their earnings, they announce their financial statements, then it is a good sign that, ladies and gents, that company is worthwhile. Because the reason why I'm talking about non-profit companies is because, ladies and gents, sometimes, ladies and gents, especially for those that are chasing or that invest in stocks or want to buy shares for capital gains, you will realize that companies that probably will do very well in the next 10 years, some of them are still unprofitable, but in the next 10 years those companies will be doing so well. So you are able to pick up those companies from their latest developments, from their latest earnings report, from their latest, of course, news that they release to investors, and follow them. And if it makes sense for you to put your money into that company, then you are, ladies and gents, you need to do that, because in the long term you will reap the good rewards. I mean, I've read stories of many people talking about Capitec was once a 10 rands per share company, and now Capitec it's over one share, it's over 1,500, which is something that, ladies and gents, I think what we learn from that is that investing, it's all about the long term. If you want to win big, if you want to make it big into the in this investing or stock market, you just have to remain bullish, you just have to remain long and strong and invest for the longer term. Don't invest, buy stock today and sell it tomorrow, unless there are serious news causing you to do that. But rather, when you invest for the longer term, because long term always wins. Otherwise, with all that, guys, I just thought I'd just give you this quick update. If you enjoyed this video, don't forget to hit the like button, comment and subscribe. And once you subscribe, don't forget to hit or click that notification bell so that at least you get notified by YouTube every time I drop a new content. Otherwise, today the JSE, ladies and gents, is of course on a positive. JSE top 40 positive. All share also, I think it's positive, which is something that means that the South African market as a whole today, it's on a positive, or it's green, which is something that is pretty exciting. Otherwise, with all that, guys, I just thought I'd give you this quick update. If you enjoyed this video, don't forget to hit the like button, comment and subscribe. And once you subscribe, don't forget to hit or click that notification bell so that at least you get notified by YouTube every time I drop a new content. Otherwise, that's all from me, and I wish you nothing but the best in your stock market investing journey, and God bless you all.